Okay, all right, Class 9, Interim Provisions. Okay. So, all right, interim provisions. The thing about interim provisions that's interesting is, so in the class so far, we've talked about doing, calculating tax expense by doing the balance sheet first, income statement second, or last, right? So the thing about interim provisions is it's exactly the opposite. So with interim provisions, it's income statement first, and it's all about figuring out what my expense is. And the balance sheet's kind of an afterthought. Okay? And I think I might have told you guys before, I used to, in this class, kind of joke with students, and as homework for the night coming into this class, I would tell you to give me the citation and the accounting guidance for what the rule is on how to change your payable and your deferred taxes each quarter. Because we learned how to do that for the year, but the question was, how would you change your balance sheet each quarter? And the answer is there is no rules. Right? So you'd go looking and you wouldn't find anything. So when you read the guidance will all be focused on figuring out what your expense is for the quarter. Okay? And so tonight we're going to focus on the P&L effect. So when Nina was speaking about her company's disclosures, she actually mentioned Fin 18. And Fin 18 was kind of the pre-ASC 740 rule for interim provisions. So on this slide you can see that I reference APB 28. APB 28 was the old rule that dealt with all quarterly accounting issues, not just tax, everything. So we would deal with, how do you book depreciation every quarter, how do you book, revenues every quarter, and then there was a section for taxes as well. But that guidance was very broad. Fin 18 was essentially an interpretation of APB 28, and Fin 18 was all tax, and it was the rule on how to compute tax expense on a quarterly basis. So a lot of times provision people, like Nina, would say, they would just use Fin 18 in kind of common speak, and you would know that meant she's talking about quarterly provisions. And so almost like people refer to Fin 48, and you would know, oh, that's tax exposures. Fin 18 kind of had that brand to it where everyone knew as soon as you said it what it was related to. Okay. But in general, the rule was that the interim period, so you see that in this first bullet, the interim period is just a part of an annual period. And the general approach, and this is kind of the punchline on all this, is the second bullet, which is you're supposed to estimate an annual effective tax rate and then apply that annual effective tax rate to income each quarter. So you don't do your provision accounting each quarter as if it's a separate period. Like you don't look at what's my payable for the quarter, what's my deferreds for the quarter, and compute an expense. Instead, you look at the year and you say, what do I think is going to happen for the year? And if I had this crystal ball and I was able to forecast, like what does my rate rec look like at the end of the year, it's going to come up with some effective tax rate. And I just apply that effective tax rate to income every quarter. And then by doing that, I'll get the right annual expense by the end of the year. Right? That's the theory. So the challenge of Fin 18 was you have to actually use that crystal ball and forecast your effective rate. So even if you're in March, you're at the end of a calendar or first quarter, and you're going to say, well, gosh, what's it going to look like by the time I get to December? What's my rate going to look like? So that means you got to forecast income by jurisdiction, perm items. You got to come up with all those things that impact your effective tax rate, and you know them now from the first part of class, right? They're all your perm items. You got to be able to forecast those things and come up with what you expect your annual effective rate's going to be at the beginning of the year. Okay? And so the challenge is in that forecasting. Okay? So we'll cover some really basic concepts, and then I'll go through an example, and I think in the example, which is really straightforward, it will click. Okay, so first thing you do is you got to figure out what this annual effective tax rate is going to be. You do it globally, and we'll talk about exceptions to that, but in general, this is a global exercise. So if you're sitting there in March and you're trying to figure out what's my first quarter provision, the first thing you're going to do is you're going to try to calculate this fraction, which is you're going to forecast your annual tax expense. So that's not your tax liability, that's your tax expense in the numerator. And you're going to divide it by your forecasted annual PBT, right, which your FP&A guys will have at your company. Okay? So a company like LinkedIn, Nina will go to her FP&A team and say, what's our forecast? She'll put that into a legal entity forecast so that we know how much income's in the US, how much income's in Ireland, etc. And then she'll calculate the numerator. Well, how much tax expense am I going to expect to see in the US? How much tax expense in Ireland? So it's almost like you got to do an annual provision early in the year just based on forecasted numbers, right? You have to kind of jump ahead of the game and see where do I think I'm going to end up. So that fraction, that's your AETR. That's your annual effective tax rate. Okay? Okay, the key is this number is not going to be right. This will be an estimate, right? It can't be right because you don't even know all the facts. But it's got to be your best guess based on forecasts, and it's got to include all these perm items, including things like credits, rate differentials for different jurisdictions, offsetting valuation allowances, all those things that play into your effective tax rate. Like if you imagine what makes up a rate rec, all those things you have to be able to anticipate and build into your effective tax rate. Okay, step 3. So you came up with your effective tax rate. Now you're going to apply that effective tax rate to your year-to-date ordinary income. Okay, and I'll explain in a minute what ordinary means. So let's say that I forecasted my annual effective tax rate and it's 25%. I think at the end of the year I'm going to end up with a 25% rate at the bottom of my rate rec. You'll take that 25%, and if this is in Q1, you'll multiply 25% times Q1 income, because Q1 income is your year-to-date income. Right? Boom, that's your Q1 provision. Right? Annual rate times year-to-date income, that's the year-to-date provision. And since year-to-date and Q1 are the same in Q1, easy. When you get to Q2, you're going to go through the process all over again. You're going to estimate your annual effective rate, and let's say you still think it's 25, right? It's almost never unchanged, but let's say in this case it's unchanged. You'll take 25% times your 6-month income at this point. So you'll take 25% times year-to-date, which is 6 months, and that will give you a 6-month provision. You'll subtract what you booked in Q1 for a tax expense. That result will be your Q2 expense. Right? So it's pretty easy math. And where the complexity, at least so far, comes in is just your ability to forecast that 25%. Right? So, so again, come up with your annual effective rate, include all the perm items and rate drivers that are going to hit your rate rec at the end of the year, apply that effective rate to ordinary income on a year-to-date basis. And the last thing is, if there's other stuff, meaning if there's things you can't forecast, if there's income that's not ordinary, because remember I used that ordinary income term, if there's weird things, which I realize is not a technical term, but you'll see the items that we'll get to later in the presentation. If there are things that are just off, they're not part of your normal business operations, we'll often book those discretely. Okay, so the term discrete will mean we book them in the quarter that they happen. Right? So a perfect example was with Nina's company, the R&D credit got reenacted. Right? That has nothing to do with the business. We couldn't have forecast that. So that happened out of the blue. They don't build that into their annual effective tax rate. They just book that kind of weird one-time thing in the quarter it happened. So that's why their rate for Q1 was super low. Okay. So we'll talk more about what those types of items are that you book separately. But know that in general, you'll have your effective rate times ordinary income, and then you'll have your weird things. Okay. And for different companies, some have a few weird things, some have a long list. It just depends on the nature of the company. Okay. Okay. So if you can follow this, man, we're doing great. This is this is the example I mentioned that will illustrate how to compute a quarterly provision. Okay. So example 1, no discrete items. So there's no weird stuff. But these are our facts. So I get to the end of Q1, and I look out into the future. I use my crystal ball, and I think my effective tax rate's 40%. Okay, that's my best estimate, taking into account all the facts I can think about. I'm going to have $400 of book income in Q1, so my year-to-date income is $400 too. Okay, then I get to year 2, and now I use my crystal ball again, and I'm looking for the year. So in a sense, I'm repeating what I did in the first quarter. I'm just trying to use better information because I'm farther along in the year. I'm halfway through the year now, right? So now as I look through my crystal ball, I think my rate's 35%, right? Like let's say I think I'm going to have less meals and entertainment. So my income for the quarter is 100. My year-to-date income is 500. So you get the idea. In Q3, I reassess, my rate's a little different. Q4, I reassess, my rate's still different, right? The rate's kind of always moving around because my estimates aren't perfect. And this is typical, right? I mean, it depends on the nature of the company, but sometimes that rate can bounce all over the place. Sometimes it's really steady. And, you know, some companies earn like a nice even amount of income throughout the year. Other companies are cyclical. Like this one would appear to be some kind of cyclical company because there are strong profits in Q1 and Q4, but then Q2 and 3 are kind of off, right? Okay, so the question was, if this was a company, what would we do for their quarterly expense every quarter? Okay? All right, so if I go to Q1, Q1 is basic. I think my rate's 40% for the year. I apply that to my year-to-date income, which is 400, which is my Q1 income. So that means my year-to-date provision is 160. Because year-to-date and Q1 are the same thing in Q1, my Q1 provision is 160. So my effective tax rate is 40%. Okay? That's really basic. Okay, so the next slide will be the first slide that becomes interesting. Okay, so now I get to Q2, and I say my annual rate is 35. Okay? I apply 35 to my year-to-date income. My year-to-date income is 500. So that means my year-to-date provision is 175. I booked 160 already in Q1. So that means I only have to book 15 more in Q2 to get my year-to-date provision of 175. Right? But now, if I look at my Q2 10Q, the effective tax rate somebody's going to see for Q2 is going to be a 15 expense over 100 of profit. So my Q2 rate, even though I didn't calculate my Q2 rate to compute my provision, the Q2 rate you see when you just look at the financial statements will be 15%. All right? So why is that? Why is my rate 15%? Say it again? Right, but why is it so low? Because I thought my rate was going to be 35%. Because in Q1, I treated my 400 of income as subject to a 40% rate. But now in Q2, I'm saying not only is my 100 in Q2 subject to 35, but I got to go back and basically correct my Q1 provision because I overstated it. So there's like a catch-up effect, right? And so you don't really want to mess up your early quarter provisions because when you get to the later quarters, you're going to be doing catch-ups, right? Sometimes it can make your rate go up, sometimes it can go down. So here, I intentionally put in a quarter for Q2 where the income for that quarter was low, so you have a you have what looks like a relatively small catch-up, but it's divided by a really small denominator in terms of the 100 of quarterly profit. So the rate really bounced all over the place, right? So if you're one of these companies where you don't have large amounts of income every quarter to kind of stabilize things, you could find that a simple catch-up, because you trued up your estimate, would have your rate going crazy, right? Like if you were the CFO and you're like, what in the hell are you talking about? My rate's 15%. Like, how can that be? I thought our rate was 35, and last quarter we said it was 40. Why is it 15? And then you're like, not to worry, next quarter it's going to be like 35 again. And he's going to be like, this is horrible, right? What is going on here? Right? Because the CFO is going to want an easy-to-explain rate, not a rate that bounces all over the place. Because if you went to the CFO and you're like, oh, what happened was I kind of overestimated in Q1 and then I fixed it in Q2, but my Q2 income was small, so the effect looks big, but that'll go away if I do it right next quarter. The CFO is going to be like, I can't say that to investors. Like, that's crazy talk, right? I need to be able to message something that makes more sense. But these mechanics, it comes up all the time in practice when people true up their estimates that they have these catch-ups, and it is very hard to explain to upper management because this is math. This is not like the business, right? And people don't want like a math answer. They want a business answer. Okay, Q3. So now I look at my crystal ball, I think it's 37%. But in Q3, I actually lost money. So Q3, I lost $200. So my year-to-date income's $300 now. So I take 37% times 300, my year-to-date income, and I come up with 111. 111 is my year-to-date provision. I booked 175 so far through 6 months. So that must mean I get a 64 benefit for Q3. So my $200 loss threw off a 64 benefit. So my rate for Q3 is 32%. Right, so if the CFO is like, this is unbelievable, right? It went from, you told me it was going to be 40, then it was 40, then you said it was going to be 35, it became 15. And now you're telling me it's 37, but my rate's 32. Like, what is my tax rate? Right? So, you know, it gets really tricky. Like one of the biggest challenges in interim provisions is explaining to management the rate on the top and the rate on the bottom are two very different rates. Right? That forecasted annual rate that is kind of the more sensible rate that will usually explain the business, it doesn't always lend itself to like a nice, neat explanation of that last row if you have volatility in both your forecast and then your income. Right? It gets really hard to manage this. And here, your rate of 32%, when you lose money, you want a high rate. Right? Because the higher your rate, the bigger your provision benefit. So everything's in like backward land. Right? So if your rate at 32%, the CFO might be like, oh, that's good, I want a low rate. Right? But you're like, oh, actually that's not good because we're losing money, so we want a big benefit. So the CFO would be like massively confused at this point. Right? And then when we get to the end of the year, I mean, we don't use this approach at the end of the year. At the end of the year, we scrap all this garbage and we do a real provision. Right? We calculate the payable, we do the deferreds, out comes the expense. And then we'll look at the expense, compute the rate for the year, but there'll also be a Q4 rate. It'll just be a function of the Q4 tax over the Q4 earnings. That Q4 rate's never disclosed because when you file a 10K, you don't disclose the quarter, you don't disclose the fourth quarter, you just disclose the year. But, you know, analysts can back into the math and figure out what the math for the quarter was. So that fourth quarter rate becomes relevant to some people, even if you don't report it in the SEC filing. Okay, how are we doing with that? Okay. All right, so in Q2, when I book my $15 provision, what's the other side of the entry to balance the entry? Real things payable. What do you other guys think? What do you think? Teja? Sure. You guys weren't listening, man. I told you there's no rules. When we calculate the rate, you don't know. We calculated the expense. You don't know if there's a bunch of current, a bunch of deferred, a bunch of APIC. Like, I didn't tell you any of that stuff. All we did on the first row was calculated the rate, right? So, like, what if this was a company where they were super profitable, but their depreciation expense was going to offset all that income, and so they wouldn't pay tax right away? They'd pay tax in the future, but not right away. Would you book the credit to payable? Right? That's the dilemma, right? But the rule, when you read the rule reads like this example. Annual rate, apply to year-to-date income, subtract what you already booked, that's your quarterly expense. The rule doesn't get into like what the other side of the entry is. Right? So most people use common sense. They say if I'm a company that pays a lot of tax, I'll book it to payable. If I have a lot of deferreds, I'll try to estimate my deferred movement. If I, have APIC, then that gets more complicated, right? So we're not going to focus on the balance sheet, but I want you to think that the rule, when you read the guidance, is all about P&L. But especially over the last 12 months, the PCAOB has been putting a lot of pressure on the big four accounting firms to get more precision on the tax balance sheet accounts, which historically, like Nina was saying, even me, I kind of don't get too excited about that kind of stuff. But the PCAOB has just put pressure on us to put pressure on companies to get that more accurate. And so even in the absence of a rule, there's pressure to make sure that companies are doing something sensible with what the balance sheet side of the entry is. But I guarantee you, when Nina was talking about all those Excel models and the slides and all that, she was doing like this. Like this page, some version of this was what she was doing for her boss. Okay, anyone have questions on this? You guys aren't talking enough. It's making it hard to eat. Okay, so I basically covered this. Okay, so no guidance on the balance sheet. The preferred method is to split it based upon some sort of common sense approach. What I think most people would tell you to do is, well, forecast for the year what your payable is going to be, forecast for the year what your change in deferreds are going to be, and if you expect, let's say you expect your provision for the year is going to be 100, and 40 of it will be payable and 60 of it will be deferred. They would say, well, use that 40-60 split, and every time you book an expense entry every quarter, book 40% to payable, 40 or 60% to deferred, and just kind of do it ratably throughout the year. Like, that's a typical approach. Some people would only look at the material deferreds and try to forecast them, because to forecast all of them is just so labor intensive. So some companies forecast intangible amortization, depreciation, but they might blow off bad debt reserve, that sort of thing. The firms have some pretty minimal guidance in the books about this stuff. This is one of those things where if you work at a company and you're not sure what your approach is, you got to figure out what you're doing and why you're doing it, and ask your auditor whether they accept it effectively. Okay, in-class exercise 1. So to challenge whether you guys are even close to following what I'm talking about. Okay. In-class exercise 1. Okay, so here's our company. So Q1, we think we're going to have 100 income for the year. Our tax rate's 40%, but we have 5,000 of credits. This is all annual information. Q2, our forecast goes down a little bit. Q3, our credits go up a little bit. Q4, the income changes. Some stuff kind of happens to explain why our rate's moving around. So I want you to calculate your effective tax rate for each quarter. And then, this information at the bottom of the page here, I want you to use this to calculate your quarterly provision for each quarter. Okay? Don't worry about the balance sheet. Come up with the expense every quarter based on the forecast at the top of the page and the year-to-date income detail at the bottom of the page. Okay? Off you go. Do you guys need me to leave that up? Say no. I'm taking that as a no. You want the top section or the bottom section? Oops. Okay, so I'm just going to keep us going here. Okay, so let me hide this. Okay, so let's do this thing. We'll do this thing together real quick. All right, so if I was calculating my annual effective tax rate as a Q1, my annual effective tax rate would be 100 times 40%. 40 credits would be 5. So I'd have a tax of 35 for the year. I think my income is 100. So my rate's 35%. Right? That's my annual rate. So if I did this at Q2, I would say 80 times 40% is 32. Credits are 5. So that's 27. 27 divided by 80 this time. What's that? 30 what? 27.5? 33.5. Okay, close enough. Okay, get to Q3, I would take 80 times 40%. That's 32 again, but now I'm going to subtract 10 of credits, so I have 22 of expense over 80. What's that? 27.25. So my rate's going down. And then I get to the end of the year, 100 times 40. Again, we're not going to do the rate approach, but we'll do it this way just to complete the problem. So we'll have 30% at Q4, right? Okay, so 35, 33, 27, 30. Okay, so now we're going to come down and do my quarterly provision. Okay, so I'm going to take 25 times 35%. What's that? About 8,500? Now you're close to me, so tell me what the number is. $87.50. Okay. So we know that our effective rate for the quarter is obviously 35%, right? Can't be anything but that. So in Q2, we're going to take our year-to-date of 30 times our rate of 33%. So that's going to be 9,900. We already booked 87.50. So our provision for the quarter is going to be like 1,200-ish. Right? In rounded numbers. Okay, 1,200-ish. So divided by 5,000, what's my rate for the quarter looking like? It's looking like it's closer to 25%. Right? I'm just winging it here off the top of my head. Okay, but the point is because my annual rate's lower, I have a catch-up effect in Q2, and so when I look at my Q2 rate, it's lower on a standalone basis because I'm moving my annual rate lower and lower, lower and lower. Q3, I take my 55 times my 27%. And 55 times 27%. What's that now? $13,500. Sounds about right. What'd you get, Sam? Oh, Sam left. What's that? 15125. You know, I never understood why my eraser doesn't work on this thing. Okay, 15125. That's my year-to-date provision. I booked 9,900 already. So that means I have 5,225 to book for Q3, divided by 25,000. So my Q3 rate looks like it's about slightly over 20%, right? Call it 22% or something like that. So again, my rate's trending lower. And then in Q4, we know that in Q4, my annual provision is going to be the 30,000. It's going to be the 100,000 of income minus 10,000 of credits. So we know it's going to be a 30,000 total minus 15,125 I booked year to date. So that means it's 14,875 divided by 45,000. What is that? 33. Okay. All right, so I have my annual rates, just like in the example we went through in the slides, where I'm forecasting every quarter what my best estimate of the annual rate is. But then when I get down to my quarterly rates, right, we can see that it goes from 35 down to 25, down to 22 or whatever, and then back up to 33, all at the end of the year to get to a rate of 30%. Right? And we haven't even gotten to the weird items yet. This volatility in the math is just a function of changes in forecast. Okay. Okay. All right, so back to the slides. So in addition to items, in addition to ordinary income times the annual effective tax rate, there's going to be some items we book separately. Okay? Items that are excluded from the annual effective tax rate where the tax effects are booked discretely. Okay? So the term discrete item is just common terminology. If you went to Nina and you said, hey, what are the common discrete items? Like, she would know instantly what you mean. She would know these are the things I don't bake into my annual effective rate. These are the things I book individually every quarter. Okay? Perfect example. So take ISOs. When do we get a deduction for an ISO? When there's a disqualifying disposition. Can we forecast whether there's going to be a disqualifying disposition? No. It depends on whether somebody actually sells the stock, right? We don't know if our employees are going to sell stock or not. That is impossible to forecast, right? But if they do sell the stock and we get a deduction, remember that's a perm item. Perm item is going to drive our expense. So if out of the blue somebody exercises and does a disqualifying disposition of an ISO one quarter, then it's like, voila, we just got a perm tax benefit out of the blue. And because that's something we can't forecast, we book it discretely. Okay? So for companies that have ISOs, the quarterly disqualifying disposition benefit is always a discrete item because they can never forecast it. Okay? It's super easy. So the items that you're going to be booking separately will be either things that, when you look at your annual effective tax rate, you're not forecasting either for the numerator or the denominator. right? Like, I can't forecast this ISO. That's an item that's going to impact my numerator, right? It's going to impact my annual tax expense. Because I can't forecast that aspect of the numerator, I book it separately. Okay? Let's say that in Q2, like, your headquarter building burned down, and you suffered like a $10 million loss. Like, you never would have forecasted that, right? So in your denominator, for your annual forecasted rate, you never would have said, oh, my building's probably going to burn down, so I'm going to forecast a $10 million loss. Like, no one would ever do that. So if, in fact, in Q2 your building burns down and it costs you $10 million, then you would book the tax effects of that discretely, because you'd say, that's something I could never have forecasted. So that kind of weird item, I'm just going to book on a one-off basis. Okay? So what this slide says is, if it's something you would exclude from your forecast of the numerator or exclude from your forecast of the denominator, usually for the reason that you can't forecast it, you book it in the quarter it happens. Okay? Okay, so typical items that you would exclude. The guidance would tell you exclude items that are significant, unusual, or infrequently occurring items. That's right out of the ASC 740 guidance. And so people debate what that is, right? Like the most often, this came up a lot in like 08, 09 when the economy was in the dump. There were lots of layoffs. And so when there's layoffs, companies book, quote, restructurings, right? Restructurings mean layoffs. And so, company X might say, oh, we're going to lay off 500 people. We're going to take a charge for $8 million. And the company would usually call that out in their earnings release and say, this is kind of a one-time thing. We're not planning to do this again. So that feels very unusual and infrequent, right? And then the economy keeps kind of taking a dump, and then 6 months later, they're like, we're going to lay off 300 more people, take a $5 million charge. And now you look at that, and you're like, I don't know if that's so unusual anymore, right? It happened 6 months ago. And, if it's a company that another 6 months go by, and they're like, yeah, another layoff, things are really rough, right? I mean, this happened back in like 08, 09, when things were really tight. Companies were doing layoffs back to back to back to back. So then you'd have this question of, well, when I'm forecasting my rate, how do I forecast restructurings? Because it doesn't sound like this is so unusual and infrequent anymore. Right? So companies would often define a policy around what types of items that they exclude based on how they felt the items that hit their financial statements were unusual or infrequent. Right? Because this is not a one-size-fits-all thing, right? People have to kind of make up their own view as to what for them is significant and unusual. A very common item that companies had back at that same time were goodwill impairments. Like, I think when we were talking about M&A accounting, and I said back in like, I think it was the fourth quarter of 08, like tons of companies had goodwill impairments. Those things, almost by definition, you could never see them coming. They're very rare. When they happen, they're huge. Those things are almost always, by definition, discrete items. But you get the idea from looking at that list that, if you just used your own intuition, these are the things that you can't forecast because they're so outside of the norm, right? They're outside of what your normal business operations are. There are specific tax things. This is the latter half of the slide. There are specific tax things that the guidance would tell you specifically exclude from your effective tax rate. Changes in valuation allowance. And that one's tricky because the effects of a valuation allowance change that you exclude are the changes because of future year income or loss. Right? Like, let's say you had a $100 NOL with a $100 DTA, and you're like, things aren't going so well, we're breaking even, we're kind of worried we're going to lose money, And then let's say that like all of a sudden your biggest customer cancels on you and says, we're using your competitor. And you're going to be like, uh-oh, that's not good. And so you may not lose money this year, but you can see like next year, you're screwed. And so if you looked out and said, oh man, I'm going to start losing money, this is tough, I don't know how I'm going to use my NOL, I probably need a valuation allowance, the charge that you incur to set up that valuation allowance, that would be booked discretely, because it really doesn't have anything to do with this year's income. It has to do with the future. If you were a company that was losing money now, and you said, yeah, it's my first year of operations, I'm losing $100, I probably need a valuation allowance, because that relates to this year's loss, you would bake that into your effective tax rate. You would essentially say, I know I'm going to have no benefit for my loss. I'm going to anticipate that. I'm going to forecast that. It's pretty obvious. It's not a future event. It's today, right? It's today's loss. It's today's facts. I know I'm going to have a valuation allowance on this year's loss. I'm just forecasting no benefit. So between those two fact patterns, even though in both cases we're setting up valuation allowances, the reason why you're setting up the valuation allowance will dictate whether it goes in the rate versus gets booked discretely. Okay? And as a general matter, if something relates to the current year income, it'll be a rate item. Change in tax rates. So let's say that next year it's June, and Obama decides our rate's too high, and the rate shouldn't be 35%, it should be 25%, and everyone's like, hey, that's great, but now all my deferred tax assets that I had booked at 35%, now they all need to be remeasured down to 25%, right? That doesn't really have anything to do with current year income. So it's not a rate item, it's something that you book discretely, because again, it doesn't have any nexus with your current year operations. So items like that will be pulled out of your annual effective tax rate, and you'll book those discretely. Okay? Very common to see change in tax rates. Like the UK's changed their tax rate like 10 times in the last like 5 years. And companies are in the pattern now of every time they change their rate, you just change your deferreds, it gets booked discretely, it's very standard. It's excluded from the AETR to the extent that the benefit relates to the prior year. So for fiscal year companies, this was confusing because some of that law change actually benefited their current year, and that benefit goes into the annual rate. But for all the calendar year companies, because the law changed like January 2nd or some silly date like that, January 3rd. So all these calendar year companies that just closed their books on December 31st, 2 days later the law changed, and they're like, I didn't book a benefit for all last year because the enacted law last year had no credit. But on the second day of my first quarter, I get this huge benefit to catch up for last year, and that's all discrete because that all relates to last year. In a way, that's very similar to like the second dashed item on here, this out-of-period adjustment. You know, out-of-period adjustment can be synonymous with return-to-provision adjustments, right? And you guys kind of got familiar with return-to-provision adjustments, if through nothing else other than through the final, right? So if you thought your meals and entertainment was 100 and it turned out to be 80 when you filed your return, there's a perm adjustment, right? You got to catch up your expense. You overstated your expense before, you got to lower it now to catch it up cumulatively. Like that 20, that relates to last year. That has nothing to do with this year. So you wouldn't blend that into your effective rate. You'd book it when you figured it out, which would usually be the third quarter when you file your return. So as a general matter, think, like, what is this item? Does the item relate to this year's income? And if the answer is no, it's probably something that gets pulled out and booked in the quarter it happens. So this is the guidance straight out of ASC 740 on the significant and unusual exception. So we've kind of already talked about this. This is the when you're forecasting your income for the year, you're not going to be able to forecast those things like restructurings or the burning down of your headquarters or the impairments. And again, for every company, it's just different. What I think you find mostly when you look at companies' discrete items and why the rate's volatile, it's not so much this, where you're excluding an income item for your effective rate. It's normally the tax items. So it's normally the ISO disqualifying disposition or the change in tax law or my change in FIN 48 reserves. Those are the typical things you see that get booked every quarter. This happens, but it is less common. Sure. So give me an example. Okay. Okay, so let me give you two examples then. So the two examples will give you two different answers. So let's say you're a account of your company, you expect your R&D credit for the year to be 100, and you say, you know what, I probably need like a 10% reserve. So I'll book a 90 benefit in my annual rate. I'll assume there's a 90 annual benefit for my R&D credit, and I'll use that to lower my annual effective tax rate. Okay? So when I do my first quarter provision, I've reflected that annual rate, including the 90 credit, and I do my rate, I do my provision, I'm done. So I go in the next quarter, and I have my R&D team come out, and they look at the reserve analysis, and they're like, no way, 10%'s right. It should be like 30%. So you guys shouldn't be benefiting 90 of credits, you should be benefiting like 70. Right? Now, when you do your Q2 rate, you should build that 70 into your annual effective tax rate as of Q2. So your Q2 rate, if nothing else changes, should be higher than your Q1 annual effective rate, because now you're taking a more conservative view of your credit. That, because it relates to the current year, would be an update, if you will, or a revision to your annual estimated tax rate. Okay? Because it relates to the current year. So that's one fact pattern. The second fact pattern would be, I've been claiming R&D credits for many years. I book a 10% reserve, and this year, it's 2013, I get audited by the IRS for 2010. They come in, they knock on the door, they look at my credit, and I'm like, uh-oh. When I look at my work papers, I think 10% reserve is way too small. I should probably be 30. So if I want to book a reserve of that extra 20, this relates to 2010, right? This has nothing to do with 2013. That 20, when you figure out you need 20 of reserve, you book it then discretely. You wouldn't build that into your 2013 rate. Does that make sense? Mm-hmm. Yeah, so it depends what it is, right? Because both of those are $20 reserve builds for R&D credits. But because one relates to the current year credit, that's something you're already reflecting in your annual rate, versus the other, which has nothing to do with 2013, other than the events of the IRS audit, which again don't relate to this year's income, that gets booked discretely. Okay? All right, so let's do in-class exercise 2. All right. Okay, so in-class exercise 2. Okay, so here's my forecasted income. It's the same every quarter. My forecasted credits are the same every quarter. My tax rate is 40%. And this is my quarterly income. So I have in Q1, I have $20,000 of income. In Q2, I have another $20,000 of income, but in addition to that $20,000 income, I have a one-time $50,000 charge. Okay, and that's non-deductible. Like, let's say I was, I remember I had a client in here who got busted for a huge fine, like a massive government penalty. And so we use them as the example. So let's say you got busted and you had to pay a huge fine that was non-deductible. So your income for the quarter would actually be a loss of $30,000. Okay, and then in Q3, you go back to making $20,000. In Q4, you have $40,000 of profit. Okay, so I want you to tell me what my Q2 rate is and my Q3 rate. Okay, those are the questions. Q2 rate, Q3 rate. Okay, so to keep this rolling, let's do it together. Okay, so when I remember, the first step in my provision for the quarter is I'm going to calculate my annual effective tax rate. What's my annual effective tax rate going to be if I get to Q2? What? The annual effective tax rate is 30%. Why? Because I excluded the one-time expense, right? So I take 30% times what? I'm going to take it times 40, which is this number. I'm going to take it times my ordinary income, right? Annual effective tax rate times ordinary income. We're almost pretending like my one-time thing doesn't exist yet, right? If that thing didn't exist, this is what we do, right? 40 times 30%, it would be 12. I would have booked $6K last quarter, so I would book another 6 this quarter, right? So that's kind of my provision before I add the weird stuff. All right, so my tax expense for the, that guy's funny. So my tax expense for the quarter is 6. But my income for the quarter, normally it would be 20, right? And my rate would be normal. It would be 30%. But this is all before I do the weird stuff, right? And then when I add the unusual item, right, what happens? My 6 is still the same, because this is non-deductible. So the fact I had a big expense didn't actually change my provision, right? The 6 expense I booked before the discrete item is still the same, because this thing's non-deductible in the first place. But my PBT, now this is a loss of 30, right? So now my rate is negative 20%. Right, so that's just useless. That doesn't explain anything. But that's what happens if you have a significant one-time item like that, where the tax effect of it doesn't correlate to what your annual effective tax rate is. You're going to end up with some rate anomaly in that quarter. Okay? So this is very similar to the LinkedIn example of the R&D credit, right? They probably had a normal tax rate, or normal for them, and then all of a sudden, whammo, some big thing changed the numerator but didn't affect the denominator. Here, our example is the opposite. Nothing's changing the numerator, but some number is drastically changing the denominator. Okay, and so in Q3, the AETR is 30% because this is on ordinary income. And ordinary income is essentially the income that excludes significant, unusual, and frequent items. So that's your ability to forecast for the year what you think is going to happen, excluding the weird stuff. Okay, so Quay, what's my provision for Q3? How do I do it? So when I get to Q3, it's September, I got to calculate my annual effective tax rate. What do we think it is? You're Kuwait, right?
Yeah. So you multiply 60,000 by the
I know, what's that?
18,000.
So 60,000, so our AETR is back to 30,000, right? Or still 30,000, or still 30% rather. Okay, so we take 30% times 60. That gets us 18. We've already booked 6 in Q1 and another 6 in Q2, so that's 12. So we have 6 in Q3. Income in Q3 is 20. So our rate's 30%, right? Okay, so the moral of the story is our rate was totally normal in Q1, it's 30%. Our rate went crazy in Q2, went to negative 20%. And then our rate snapped right back to being normal in Q3. And the point is that when you have these discrete items, the effect is isolated to the quarter that you booked the discrete item in. There isn't the catch-up effect like we had with the change in the forecast in the earliest part of class. Okay? If there's a discrete item, the effect of that discrete item gets booked discretely in the quarter and doesn't reflect a correction for the past or some kind of catch-up or anything like that. It's everything that relates to that item gets booked in the quarter. Doesn't affect the future. So what you would see with a lot of companies that had that R&D credit increase, their rate might have been normal, then the law changed, so there was a big benefit all of a sudden that lowered the tax rate, and then the following quarter the rate went right back to normal. Okay? And that's typical of a discrete item if you have kind of a one-off discrete item that doesn't repeat every quarter. Right? If you were doing restructurings and you treated restructurings as a discrete item, it would be the same effect. The only difference would be with a restructuring, it could be different than here because here we've assumed this is non-deductible. Right? If this was deductible, then not only would you change the denominator here, not only would you change the denominator, but you would also change the numerator. Right? Because if you pay somebody severance as a layoff, then that's deductible. But the deduction you get might not be at a rate which is your annual effective tax rate of 30%, right? You might get a deduction at 35% or 40%. So there's still going to be some rate anomaly unless the rate that applies to this discrete item is the same as that annual rate, and it almost never is. So in our example where we assumed it's non-deductible, it's really obvious to see the effect. But the same thing will be true if the item is deductible or taxable. Okay, you with me there? I don't feel like you're with me. Okay. So far, every time I teach this class, I always think that somehow I have to put something at the very end of the semester to motivate you to stay remotely alert. The shame is the last class is the most interesting class. So if that's any sort of plug for coming half alert, the last class is content-wise or intellectual curiosity-wise, that's the most interesting stuff. Okay, so the point is, you can have rate volatility from quarter to quarter for many reasons, right? The first reason we already learned was this kind of catch-up effect when you revise your annual forecast, right? The second effect we're learning is changes in one-time items that don't get baked into our forecast, but we book them discretely to a quarter, okay? Everyone has discrete items. It's just a matter of what those discrete items were. So if you did your homework and you went and got a public company and you looked at their Q1, 2, and 3 rates, and you tried to identify why they're volatile, the reason is one of those two reasons so far, right? And there's more reasons to come. But it could very well be, and so many companies in the Valley had this, it could be that R&D credit change. Like that might have been a common answer when you guys looked at your homework problems. Okay. Okay. Okay, I don't think I'm gonna skip that one. Okay, I want to go to this one. This one comes up all the time. It might seem kind of obscure, but I remember writing the CFO of a really large brand name company in the Valley an email trying to explain in like big company CFO terms this issue. Because I remember it was this company that the tax rate, it was a really big company, the tax rate for this company one quarter was like 65%. And the CEO like blew his lid. And he was like, no. Like it's not 65%. And I'm like, yeah, it is. And it was because of this issue. And so then the CEO, like, who's like a kind of a celebrity type, he like summoned a tax person to like come and explain the rate. Like, come to my office, explain why it's 65%. And I remember I was sitting with the VP of tax, and she was like, you're not going to believe this. And then I was like, I'll do it. I'm like, I want to meet this guy. This is going to be great. And so for a while, I thought I actually might go meet like CEO of like a large company and explain why his tax rate was 65% because of some quirky Fin18 rule. And then the VP tax like, I can't send an advisor. This is not a good idea, right? Like, how would that look if you sent an advisor to explain your tax rate? So then she ended up sitting in his office for like his waiting area for like 2 hours, and then the guy actually never opened his door and didn't have time to meet with her. So there was never a meeting, but that was the closest I got to having my celebrity encounter. It was no Kim Kardashian moment, don't get me wrong. But if you're nerdy like me, it was the next best thing. Okay, so here's the issue. Okay, so this used to be paragraph 22A of Fin18. Okay, and a lot of people know what 22A is. Not that many, but that's an often cited rule. Fin18, paragraph 22A. And what 22A basically said was, remember earlier, I said when you're forecasting your annual effective tax rate, you do it globally, right? And so every company we've had come and guest speak, they're all global companies, right? Pretty much everyone in Silicon Valley is global. And so, you got to think, well, if I'm forecasting my annual effective tax rate, I got to forecast, each jurisdiction's provision and income. And then I got to add them all up and average them, right? I mean, that's essentially what you're doing. And so when you get to March, right, and you forecast for the year, and you're like, okay, what's my annual rate going to look like? You got to forecast jurisdiction A, B, C, D, E, right? And you got to know how your annual business forecast translates into your legal tax structure, which is not the easiest thing sometimes. So in this example, there's two jurisdictions. Jurisdiction A is a loser. Jurisdiction B makes money. Okay, so you can see in jurisdiction A, they lose money every quarter, and for the year they expect a loss of $320. Jurisdiction B is profitable every quarter, expects a profit of $800. Okay? Second bullet from the bottom. Management expects that jurisdiction A is going to have a VA. Right? That loss is going to provide no financial statement benefit. The rate in A is 30%, the rate in B is 40%. Right? What is the effective tax rate for the year? And then if you assume that the quarter comes in each quarter the way it was forecasted, what's your tax expense every quarter? Okay? Hold on, let me peek ahead and see what that is. Okay, so let me just do it off of this. I'm going to scribble with my messy handwriting, and then I'll show you the solution. Okay, so the Rule 22A, or Paragraph 22A of Fin 18, what it said is, if you have a loss jurisdiction that you cannot benefit any of the loss, you exclude it from your annual effective tax rate. Okay? So even though the general rule is you do the effective tax rate forecast globally, the exception is 22A. 22B is another exception, but that was the one we skipped over. 22A you see frequently. And so the exception is if you have a loss jurisdiction where you can't provide a benefit, exclude it, pull it out. So that means that if I look at Q1 and I say, what's my annual effective tax rate going to be? If I exclude jurisdiction A, well, my effective tax rate is going to be pretty darn easy because it's only jurisdiction B. And jurisdiction B's tax rate is 40%. Right? So if I calculated my tax for the quarter, I would take not my year-to-date income of 150, I would take just B, because I'm excluding A. I'm kind of pretending A is not there. Right? I'm like, A, you're a loser, you stand in the corner, no one's going to talk to you, we're just going to deal with B. Right? That's kind of what's happening here. So with B, I take 40% times 200, my provision is 80 for the quarter. So that means my effective tax rate, if I looked at my 10Q for Q1, my effective tax rate is going to be just more than 50%. Right? So 80 divided by 150. Anyone? 53%. Okay. So now I get to Q2. What's my AETR for Q2 going to be? Good guess, 40. I'm being sarcastic. Right? We're excluding B. A is still standing in the corner. No one is talking to A. We pretend A is not there. Right? It's a loss jurisdiction. We can't benefit it. They're nothing to us. So all we're doing is forecasting for B. B hasn't changed. B is 40%. So our annual effective tax rate is still 40%. So now for our tax for the quarter, we would book 40% times B's year-to-date of 400. So that would be 160. We'd subtract the 80 we booked. We'd have another 80. 80 over 130, 62%. So you get the idea, I think. Rate's 40%, provision's 80. My income this quarter is only 100, so now my rate's up to 80%. And this is where, like, the CEO calls. He's like, enough, right? It cannot be. And so, in the fact pattern that I was referencing in my story, the fact pattern was more like this. It was kind of like you had A and B. Say A is my loser. And for Q, 1, 2, 3, 4. Let's say it was like break even, lose $100, break even for 100 loss. And then this was, say, 200 a quarter for 800. 700 annual profit. Let's say B was 40% and A was, who cares, because it doesn't matter. Okay? So in Q1, my effective tax rate is going to be 40%. Okay, in Q2, right, my income on my 10Q is only 100. But my tax rate is going to be 80%. Because I'm going to book 40% of this 200 effectively. That's 80. And I'm going to divide it by the 100, essentially, when I look at my 10Q. And then it's going to go back to 40%, 40%. But here, A's losses didn't occur ratably throughout the year, right? B's income was happening every quarter, 25% of my annual income happened each quarter. Whereas for my losses, they all happened in one quarter, so it wasn't ratable. So that means because I'm not blending A and B into one annual effective tax rate, and I'm effectively suffering A's losses in Q2 alone, I get this blip in my rate. Right? Because remember, the whole idea here is when I do my provision calc, I kind of blow these guys off. Right? It's like I pretend they don't exist. And the only time they do exist is when I compare my tax for the quarter to my PBT for the quarter to get my 10Q ETR. But this is the result, right? This is not something I actually use to calculate anything. That is the answer. And so I had to explain to the CFO first, and then I wrote this email that was supposed to go to the CEO. I was supposed to explain why this was the pop, right? And the answer was because if you had in here 25 of losses every quarter, this 80 would have been smoothed out to the quarters, mathematically. But because all those losses hit at one time, and I wasn't actually changing my numerator, right, mathematically, I got this pop in my rate. And so you can imagine, like, writing an email to, like, the CEO who, probably doesn't even do his own taxes, knows nothing about taxes. And you're like, right, there's this 22A thing, and how it works is you exclude these losers, and, there's just no way they're going to keep reading past that, right? So, but what happens is when you have that fact pattern where you have loss jurisdictions without benefits, if those losses are incurred at a rate that doesn't mirror the profits for the rest of the company, you will get rate anomalies just mathematically. Okay? It will always happen. All right, questions on that? I know you guys are thinking, when is class going to be over? But this, 3 years from now, you'll be working on a provision, you'll see this fact pattern. It will make me feel good if you'll, remember this and be like, yeah, that thing, 22A, right? Okay, so this is the solution, but I don't think it's as powerful to just see all the numbers as it is to kind of write it out and think it through, even with my messy writing. Okay, so I'll come back to 3 and 4 in a second. So the rest of the slides, there's, I think 3 pages here. I just listed out things that are discrete that go versus go in the rate. So this isn't a comprehensive list of all the things that you could possibly think of as being rate or discrete, but it's a list of 15 items to give you an idea of what would be discrete versus rate, right? So Rilla's question was this. Adjustments to UTBs. If it relates to a prior year, it's discrete. If it relates to the current year, it's rate. Right? Accrual of a penalty for a prior year tax contingency. Right? Your key is prior year, boom, discrete. Accrual of interest related to a prior year tax contingency. Okay, this one's interesting because the interest is actually the current year interest. Right? But interest by definition is going to be discrete. Trust me. Okay, so let's say that, here's a good one. You're like, I know, this is fun. So this one is both. Okay, so let's go back to my example. Let's say Obama's like, man, those Republicans, they have a good point. Let's lower the tax rate, right? Like that will never happen, but let's just assume it would. So we're sitting there in June, and Obama goes, yeah, let's lower the corporate tax rate from 35 to 25. Let's make it effective July 1. So for calendar year companies, the last half of their year, we're going to allow them to be taxed at only 25%, not 35, right? Just imagine, like, what a great day. How sunny the sky would be. So in that situation, you have a discrete effect because your deferreds that you had set up for prior years, those are all going to be at the wrong rate, right? Your depreciation, that thing's turning at a new rate. Before you set it for 35, now it's going to flip probably in the future at 25. All that prior year deferred remeasurement, that's all discrete. Okay? But if you were making money that year and you were profitable, the fact that that year's profits were partially going to be subject to a lower tax rate because of this lower rate, that lower rate on this year's profit would make you reassess what your annual effective tax rate was on this year's income. Right? So it's just an example of something that can actually throw off both. So here's a whole bunch of valuation allowance examples. Right? So if you're AMD and you're losing money and you need a valuation allowance on a loss from the current year, you just build that straight into your rate and just kind of book no benefit. You know, you don't kid yourself and book a benefit through the rate and offset it with a discrete valuation allowance. You just blend them all in the rate. But if you realize you have like some epiphany, you know, you don't have a valuation allowance, and then you realize you do, you know, all of a sudden you need a VA for assets existing at the beginning of the year, then, you know, that doesn't have anything to do with current year income. That's just you looking at last year's deferreds and saying, those got to go. Right? And if you say, I had a valuation allowance, I was losing money, I'm a drug company, all of a sudden I got this great FDA approval on a drug, I'm going to make more money than anyone's ever seen before. You know, FDA approval did it, and you're like, this is great, valuation allowance is coming off, right? That's profits for the future, right? So that doesn't have anything to do with current year earnings. I mean, the FDA approval might be this year, but it's earnings, it's income, right? It's matching with the income. So boom, that would be discrete. Okay. Okay, so you get the idea. So I would prefer to save my voice. I have to speak the next 2 days, actually, at different events. So you can go through example 3 and 4 on your own if you want. One of those deals with 22A, which we talked about. The other deals, I think, with 22B. 22B is very similar to 22A. It's basically saying you exclude jurisdictions where you can't predict, you can't forecast. Like one of my clients, very near to here, their biggest jurisdiction for operations is in Nigeria. I know, right? And, you know, imagine like calling up Nigeria and be like, how do you guys think you're going to do this year, right? Right. Like the reliability of coming back is not so good. Right? And so, you know, when we look at their forecasts, and I know I'm kind of joking, obviously, but if they just call back and they're like, we have no idea, right? Depends on like whether there's, you know, violence in the country or something like that. You're like, wow, that's crazy, right? You can't even predict your business because you don't know like how stable your government is or that sort of thing. 22B would say, take those jurisdictions out and kind of deal with them separately too. Because we don't want you messing around with, you know, jurisdictions where it's so hard for you to forecast. Do the ones you can forecast, and then basically treat these unpredictable ones as more weird stuff where you just book it as it comes. And that's, in my very casual way of explaining it, that's what 22B is. Right? So 22A is exclude the lost jurisdictions, 22B is exclude the weird stuff. Okay, so why do they have 22A? What is the principal reason from an accounting theory perspective? Why do they have 22A? What's it there for? Anyone? What are we trying to avoid? Let's use my example here of my company with this $100 loss in Q2. You guys are like, I don't know, tell me. Okay. My annual expense for the year is going to be 800 times 40%, 320. 320 divided by 700 is what? What is it? 46%. Okay. So if 22A didn't exist, and I used a global rate, I would just multiply this times 46. And then this times 46. Right? And that and that. That's what I would do. Right? So as a result, if I compared, okay, so this page is getting like impossibly messy. Let me do it one more. Okay, so I said A, B, and I said it was 0, 100, 0, 0, 200, 200. Okay, so if I said it was 22A, then this was 40%. This was 80%. 40%, 40%. Okay. So if I did a global rate, I would take 46% of 200. So that would be that would be 46%. I would take 46% of 100, 46%, 46, 46, right? That's what I would do. So the question is, why is this better than that? Right? And the reason is, and I remember trying to incorporate this into my email to the CFO, the reason is the guidance is trying to avoid this. They're trying to avoid an implied, with two I's, special, implied benefit on the loss. Right? Because if my rate was 46% for Q2, in effect, I'm benefiting the loss on the $100 by 46%. And they're like, oh, we don't want that. We don't want you showing the reader that you got a benefit for that loss. We always want you telling the reader that you didn't get a benefit on that loss. So wouldn't it be better to isolate that, and instead, in the quarter that you had that effect, show that pop in your rate rather than blending it? That's the reason. The reason is, in the quarter you have the loss, if you applied an effective tax rate to it, you're basically saying that loss indirectly has a benefit. And although you get to the same answer at the end of the year under both approaches, on a quarterly basis, the accounting theory is they don't want you indirectly showing a loss that wouldn't have a benefit, that by applying the effective tax rate shows there is a benefit. They think that's misleading. So it's better to isolate those jurisdictions that have no benefit and pull them apart from the effective rate. That's the theory. Okay. So we learned 3 reasons why your rate could be volatile. What's the first reason? Catch-up, right? Changes in my annual forecast. When I get to later quarters, there's a catch-up effect. What's the second reason my rate could be volatile? Discrete items, right? There's a million of them. Okay? What's the third reason my rate could be volatile? 22A. Okay? So when I book a provision expense for the quarter, what's the other side of the journal entry? Depends. Okay, you guys have mastered quarterly provisions. Honestly, if you can remember those things, you start with an annual effective tax rate, you do your quarterly provision on a year-to-date basis. Your rate can be volatile because of changes in your estimates as you go throughout the year, discrete items, 22A or 22B. Balance sheet, it's hard to know, right? Use common sense. You come up with something that's sensible for your company. Man, in a nutshell, you got it. Quarterly provisions are easy. It's funny, in my experience, what happens is companies go through their annual provision. It's hard. Sometimes things blow up, like my example at the beginning of class with that whole Channel 3 thing. And then, like, management who doesn't understand provision, they, like, overreact. They're like, in Q1, we better get it perfect. We better throw, like, 100 people at this thing. You know, it's got to be just nails tight. And you're like, I know, but it's really easy. We actually don't do all that math we did at year end. And then it's a breeze. And people realize they kind of overreacted a bit. It happens like every year. Quarterly provisions are just much more straightforward. Okay.